to have you on the show. Wish you festival greetings and a happy new year from all of us.
Thank you, Aisha, and same to you, and happy Diwali to all the viewers. Belated, but I think it's hopefully a beginning of another good year.
Yeah, I hope so. Will it be though, Punita, because we've left behind an excellent, last 1 year of gains, a wobbly October now. Is it only prudent to hunker down your expectations of the kind of returns that you're going to make in the year ahead?
Yeah, and I think when I say good year, it's more, I think it's going to be better for the economy. The economy is definitely recovering, and we are seeing earnings also coming out pretty good in most companies. But I think the markets have already anticipated the strong earnings growth and are discounting that in the valuations. So, which markets always do. The markets always lead the economic growth. So, I think in India in particular, while the growth is going to be strong, I think the valuations are pretty stretched in terms of when you compare it to some of the other global markets.
Yeah. So what happens, Punita, now? Given that valuations are looking frothy in pockets, you think earnings will be able to match up to the kind of valuations that some of these stocks and sectors are trading at, or do you think one has to really bring down you know all the metrics that one has been analyzing markets with right now?
Yeah, no, that is an important thing to focus on. So for first, I mean, I'll just elaborate on my point on the valuations of the market as a whole versus other global markets, which is if you look at the Indian market, while it did well throughout the year, the real rally, the sharp rally happened starting, I think, May or June, around that time. And that's when, if you look at the charts of what happened in the Chinese and some of the other Asian markets, and you look at the Indian market, there's a big divergence. So the Indian market went up, and the China, MSCI China, and some of the other Asian markets went down. So there was a lot of money that came in from people allocated, fund managers allocated more money to India and took money out of China, Hong Kong, and some of the other North Asian markets. And some of that was obviously due to the regulations tightening up in China and other concerns about the Chinese economy. So India really benefited. But today, there are global investors. I think most of the investors in the emerging markets have already allocated quite heavily to India. They're mostly everybody, the consensus weighting is an overweight in India. And most people have gone underweight in Hong Kong, China. So when you look at the valuations now of India versus China, India is trading at a very, very high premium, more than it has ever traded at. And so while the Indian economy is going to look better and look perhaps better than the Chinese economy, people are focusing back on valuations and saying, well, India has never really traded at this kind of a premium to China. And does it deserve this kind of premium? And should investors, despite what is happening in the Chinese economy, should investors again start relooking at perhaps increasing their allocations to China? So some of that is going to impact what happens to the Indian markets, is how these flows and the valuations kind of are reflected in what investors do. Now, of course, India also has a strong domestic mutual fund industry, and the retail participation has been strong in the markets with all the IPOs. But I think it's only a question of time before everybody starts really getting concerned about the valuations and really getting much more selective. Right now, I think we've had a very strong rally across the board, but I think it's time to get more selective.
When you say selective, Punita, where is it that you see opportunities given that there is a sectoral churn which is now playing out quite evidently in the markets?
I think you have to be focused on value and and of course growth at a reasonable price, and which means that across the sectors, I mean, India is a very broad-based market. So there are opportunities across the board. But I think financials is an area that has lagged in many ways, and that typically does well as the economy recovers. So I think that's an area one should still be looking at. Consumer discretionary as the growth picks up again. Real estate, you've talked about this morning. I had talked to you about real estate, I think, a couple of months ago in my interview with you, and I still think there are opportunities there because that's a sector that hasn't done well. Healthcare has not, over the last couple of months, we've seen some corrections there, but it's a long-term secular story because this is a sector that is going to see continued investment after the pandemic. And so there is opportunities there. One has to get very selective on, I think, the IPO activity because there's just so many IPOs coming out. And not all of them are going to be trading up after the listing. And so I think one has to get more careful there as well. So I think when I mean selective is just be much more focused on the valuation so that any growth disappointments are not going to give a big hit. Now look at, for example, what happened to Moderna in the US, right? Moderna is a stock that has been on a tear. It's been doing extremely well. And just a slight amount of disappointment or maybe analyst expectations weren't met, the stock collapsed 40% in 2 days. So given where valuations are, I think there is very little room for disappointment. So one has to be selective as a result.
Right. Punita, the other thing that I wanted to talk to you about was the fact that Fed is tapering. They mentioned that in their commentary in the week gone by. What kind of an impact would it have on equities? Because for now it seems that, whatever the Fed has been saying is par for the course, and that's something that the equity markets have already priced in.
I don't think the equity markets have really priced in fully the Fed tapering. I mean, if you look at the Fed's balance sheet, since last year, it has expanded by $3 or $4 trillion. That's a lot of expansion. And as the Fed starts tapering, some of this is going to obviously, this liquidity is going to get pulled out of the markets. And it will definitely have some impact. And the reason for the Fed tapering, at least in the US, and every economy is at a different stage, but in the US, we have very strong employment. Everybody's getting a lot of jobs, and a lot of people have quit the workforce and they've just made a lot of money either in the stock markets or they feel that they just don't need to work because of the stimulus packages. So there is wage inflation. Inflation forecasts, if you look at what analysts and economists are forecasting, is while, about a year or two ago, inflation was running at about 1%, the forecasts are that CPI in the US is already running at 4 to 5%. That's pretty high. And of course, the forecasts are with the Fed tapering that these numbers, inflation will come down next year. We see similar patterns of inflation rising across the globe because of supply chain and stimulus packages, etc., supply chain disruptions, etc., and the demand picking up. Now, India is slightly different in the sense that we've not had so much wage inflation. Our employment activity is not as strong as what we're seeing in the US, and growth is still, I think, not at its peak. The companies are not operating at peak capacity. So we may not be as concerned about inflation, but if global liquidity starts getting reduced, that will have an impact across the globe. And then we would be very reliant on our domestic flows to keep the markets buoyant.
Since you just briefly highlighted about inflation, Punita, I just wanted to understand, because inflation has really been, felt here in India as well and been felt by India Inc. We can hear that from the management commentary. Most FMCG discretionary companies are alarmed and shocked by the inflation levels. I mean, Asian Paints in the commentary said that they haven't seen such kind of inflation numbers in the last 3 decades or so. And this at the cost of, well, up until now, they're able to really pass on the raw material cost inflation on to consumers. But at some point, they'll have to choose between margins or volumes. Just wanted your take on what one needs to do with inflationary sensitive sectors.
Well, first of all, there is a view that this inflation is transitory. I'm not sure I fully subscribe to that. I think it'll take some time for the supply chain issues to resolve. A lot of companies are definitely reliant, a lot of sectors are reliant on China for the raw materials, and that's also been a problem. So, um, the dependency on China is clearly hurting the global economy. And so companies around the world have been diversifying their supply chains and trying to find alternatives. And that might take some time, but hopefully that'll eventually, create some kind of less pressure on the companies in terms of their supply issues. So you're right. I mean, I think inflation is a concern, but I don't think we're seeing the kind of wage inflation in India yet. And so the demand side hasn't really picked up as strongly. So inflation is really, I think, supply led, and whether companies can pass on that depends a little bit on how the demand grows, because we still haven't fully recovered and gone back. I think there's still a lot of unemployment. And so as that improves and the demand keeps up, then I think the companies will be able to pass on all the prices, because I think some consumers are already feeling the pressure, as you said. And so we need to see certain amount of employment activity picking up and the demand keeping pace. And then perhaps there may be less margin pressure on the companies. But yes, for the short term, there is some margin pressure because of all the raw material prices.
That's so great to have you on the show. Thank you so much for taking